Hey everybody, this is Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, April 19th, 2025. How you doing? I appreciate you coming to my weekend review podcast. I hope you're having a nice weekend. Hope you had a good trading week last week. Market's been a bit crazy. I've been a bit sick, so I apologize for not being able to do the podcast last week, but boy, I was really feeling bad. I went out of town. I was meeting with the client, and when I got back into town, I just really started to feel badly. And anyway, I had to go to the doctor, had to go to the hospital. Um, I had influenza, and it's just horrible. I haven't been that sick in 20 years, and I just coughed so much that I just didn't have my voice. Excuse me. And so you're probably going to get a couple of those today as well. And so I just couldn't do the podcast. So my apologies. The trades that I made last week, we'll go over this week as well, because I did exit a couple shorts last week as well. But again, I hope you're doing well. I appreciate you coming here. I hope it's going to be valuable for you and that you're going to learn something good. And so the format for today is, first of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I've made over the last 2 weeks. We'll talk about when I entered the trade, why I entered the trade, what the setup was, what the signals were, and how I position size correctly, how I place my emergency stop, how I place my end of day stop, um, how I manage the trade if it starts moving my way, how I take partial profits, and then ultimately how I am going to exit the position as well. When I entered the trade, why I entered the trade, and how I am going to manage the trade going forward. After that, we'll talk a little bit about trader psychology. Always the most important skill in trading is the ability to just create a plan and, more importantly, follow the plan. Sounds easy, not easy for some people. Very difficult for some people. Easy for others, and that's a gift. That's a blessing to have that. But a lot of traders, they struggle with that. And so I've been trading for over 30 years now, and the important part is get yourself a good trading process, a black and white trading process. If it does this, then I'm going to do that. If it does that, then I'm going to do this. It's a much more holistic way to trade. It's a better way to trade. But the key is you have to follow that plan. So get yourself a trading plan, whether you get it from me or you get it from someone else. Get that trading plan, and then most importantly, you need to follow it. After that, I have gone down through my watch list, both on the daily time frame and the weekly time frame, and I have identified some potential trades for next week that I'm interested in. Some potential trades that are coming into some areas of support or resistance if they're short trades, and some confluences are starting to set up. Us as individual retail traders, the number one advantage that we have over the large financial institutions is that we are able to just sit and wait for a particular market that we're looking at to get to a level that has confluences or multiple signals happening at the same time. Large financial institutions, they can't do this. They have to be in the market. They're buying and selling, but that is our number one advantage that we have as individual traders, and people don't take advantage of that. And so, what I do on Friday nights is I go down through my watch list, and I look at all the markets and say, oh, this one's kind of getting close to, maybe a deep dip buy. This one maybe is a deep dip buy and a bullish order block. And if it does this next week, if the price action is such that it gets me interested in the trade, then I will take that trade. And so that's what I will do here in the podcast. Particular markets that are close to potential buy areas or confluences, I'll point those out. They're still not there. If they were there, I would have already taken the trade, but they're getting close. And in my experience and all the years that I've been trading, this is really the best way to go about it. Let the trade come to you. And then if it gets there, then you can make the decision on it if you want to take the trade or not. All right. So, like I said, hopefully this is going to be helpful for you. If it is, and you find some value in it, I would appreciate if you could hit the thumbs up button. Really helps to build the channel, lets YouTube know there's some valuable content, and helps keep the channel going. So I apologize in advance for my voice and my groggy voice and all of that. But anyway, we'll just do the best we can today. So I'm going to run the U.S. legal disclaimer. Let's get that out of the way, and then we'll get rolling. Thanks.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
Okay, well, let's get started. Again, I haven't done the podcast for 2 weeks, so there are some trades in the past that I took, and we'll go over those and explain why I took the trade and how I am going to manage the trade going forward. So this is NVIDIA. I entered NVIDIA back on the 7th of April, and the confluence here were two things. First of all, you see the green box here. This is a bullish order block. Now, whenever things get into a bullish order block, I become interested. And so this is a combination of a bullish order block. Let me show you what the order block is. Have to go way back. A bullish order block is when you have your lowest bar close before you have structure change to the upside. And so this happened back here on August 5th. This was your lowest bar close. Then here we change market structure to the upside. And then you can see as soon as it changed market structure to the upside, it came back to the bullish order block and then took off like a rocket ship. I didn't take this trade, but you can look back in the past and you can see these order blocks, and you can extend these order blocks into the future. And more often than not, when you create an order block, or you have your lowest bar close, you change market structure to the upside, if and when in the future that market comes back to that order block, it's generally a good time to potentially look for a long signal, as long as you have a confluence and you have legitimate signals inside that order block. The way that I like to explain order blocks is that if we take the high here in November of 2024 and we look back at this order block, it's pretty clear that this was a good time to buy this particular market in NVIDIA, right? In hindsight, it was very clear that smart money was buying in this order block, right? If we look here and we look back here, we go, oh yeah, clearly there was some smart money buying there. Well, so that means that in the future, if we go back to this order block, we are kind of buying in the same area that the smart money did back here in August of 2024. Now, you can have smart money here, and then in the future, this may not be a smart money area again because things have changed, right? I mean, a lot of things have changed with the economy and the tariffs and politics and all that kind of stuff. But on its face value, you are back into that same area. So this is an interesting spot for me to potentially get long, and I did get long. So first things I want to mention here is that we do have the bullish order block, and when I took the trade back here on the 7th of April, we are in the order block. So big picture, we have a bullish order block, something to keep in mind, something to take a look at and get interested in. So on top of that, just because we are in an order block doesn't necessarily mean I'm just going to go ahead and buy. I want to look for some other signals as well, tactical signals to get me in the trade. Well, you hear me talk a lot about deep dip buys, right? I mean, for the last couple of years, we haven't had a lot of deep dip buys, but lately we've had all sorts of deep dip buys. And deep dip buys are when you get to the 200-day moving average, the 250-day moving average, the 300-day moving average, or the 30 RSI level. These are all legitimate deep dip buying signals. So I took the trade here on the 7th of April at 97.74. One, because we're in the bullish order block. Two, we had a deep dip buy of an under 30 over 30 on the particular day that I entered the trade, the 7th of April. We opened up under the 30 RSI and closed above the 30 RSI. So that by itself is a legitimate signal, but when you overlay it into the fact that one, it happened into the bullish order block, and two, we rejected the bottom of the order block. Here's the bottom of the order block, here's the top of the order block. Rejecting the top of the order block, rejecting the bottom of the order block, that is a legitimate signal by itself. So when you put this trade all together, we had a pullback into the bullish order block. We had a intraday rejection of the 30 RSI. It opened below 30 RSI, closed above 30 RSI, and it also closed above the negative third ATR channel, or the negative third Keltner channel. By itself, this is not a legit signal, but if you take it, if you put it all together and you aggregate everything together, it improves the chances of having a positive trade if you reject the negative third ATR channel, because 92% of prices, when they reject the negative third ATR channel, tend to go up. So, one, we're in the bullish order block. Two, we had an intraday rejection of the 30 RSI. Three, we rejected the bottom of the order block. Four, we rejected the negative third ATR channel. So that is why I got long at 97.74. Now, when you see an entry, the first thing, and you decide that you're going to take the entry, the first thing you need to decide is how many shares I'm going to buy. It's the most important decision you're going to make in the trade. So what I do is I use two inputs. I put in the how much do I have in my trading account, and number two, what is the value of the two ATR. Right now it's $14.44. You can see this up here. So I take 1% of my capital. If my capital is $100,000, 1% of that is $1,000. Then I take that $1,000, I divide it by the value of the two ATR, whatever that value is on the day that I buy it. And that tells me to buy exactly 69.25 shares. So I'm just going to round that down to 69. So I enter here because of the signals that I just mentioned, 97.74. I buy 69 shares because using the two ATR helps me position size based upon volatility. If the volatility is very high, I buy fewer shares. If it's low, I buy more shares, and that's really the way you should do it. And so I buy here 97.74. And the first thing I do after I buy my 69 shares is I place my emergency stop 2 ATRs below, exactly $14.44 below my entry. So in the future now, if I have 69 shares and they go down $14.44 to my emergency stop, how much have I lost? I've lost 1% of my capital, right? Not fun, but survivable. But the good news is the emergency stop only happens about 5% of the time. The other 95% of the time, if I have a losing trade, it will not be my emergency stop that kicks in. It will be my end of bar stop. And on a deep dip buy with an under 30, over 30 RSI, if I took the trade because it went under 30, over 30, then my end of bar stop is simply a close under the 30 RSI. And if it closed under the 30 RSI, very likely that's going to happen at a much higher level than my emergency stop. So does that make sense? I hope that makes sense. So anyway, took the trade here, 97.74, put my emergency stop 2 ATRs below. My end of bar stop is simply a close below the 30 RSI. And you can see on the day that I took the trade, look, 33.24. So clearly during the day, it was under 30 RSI, closed above the 30 RSI. So if the next day it simply closed below the 30 RSI, I would just be out of the trade. All right, so we have the trade set up. I showed you how I position size. I have my emergency stop 2 ATRs below. I have my end of bar stop a close below the 30 RSI. Now, the very next thing that I do is I place my trailing stop level. And trailing stop level, I always use the value of the 1.5 ATR. Right now, that is $10.83. So I take my entry price, I add the value of the 1.5 ATR on the day that I took the trade, and I place that 1.5 ATRs above. And all that is a level that if I get to that level, now I go into trailing stop mode, which just means if I have a close below a previous bar's low, I'm going to get out of half of the trade, which I did here on Wednesday, because you can see we closed below a previous bar's low after reaching trailing stop level, and I take off half the position. So everything I've talked about so far, the position sizing, the emergency stop, the end of day stop, going into trailing stop level, these are all considered defensive moves. So in other words, if the market goes against me, I'm going to take some type of action if it goes against me. Defensive. But in trading, I like to also play offense. And the way I play offense is I take partial profits each day if the market moves a certain amount from the previous day's close. So I am in this particular trade right now. Let me show you exactly what I mean by that. So on Wednesday, I took half off, right? Because got to trailing stop level, had the first close below the previous bar's low, I took off half. So I still have half. So let me show you how I'm going to set the profit targets for Monday. I take the closing price, which right now is 101.43, and then I look for the value of the 0.45. The 0.45 ATR is 325. So I have the closing price 101.43 plus 325. My first profit target for Monday is 104.68. So come here, 104.68. That's my first profit target for Monday, 104.68. Now I'm going to do it two more times. I'm going to take the 104.68, which is the first profit target. I'm going to add the value of the 0.45 to it again, 3.25. My second profit target for Monday is 107.93. So put that in there, 107.93. And there's my second profit target for Monday. Then I'm going to do it one more time. Take the second profit target, 107.93 plus 3.25. My third profit target for Monday is 111.18. Okay, so there we go. Now, those are my three profit targets for Monday. And how much profit do I take at each level? I take 10% of however many shares I went into the day with. If I went into the day with 100 shares, I'd place a limit order for 10 shares at the first profit target, 10 shares at the second profit target, 10 shares at the third profit target. And maybe I hit one, then I reduce my overall position size. So maybe the next day, instead of taking 10, 10, and 10, I take 9, 9, and 9. But it's a very good way to take partial profits, take advantage of selling into strength when you have the strength there. And then it also reduces your overall position size. So if the market reverses on you, it helps mitigate the loss. So I'm a huge fan, I'm a huge proponent of taking partial profits when the market gives them to you. So you have both. You're playing defense and you're playing offense. Okay, so just kind of a big picture again. Why did I take the trade? One, we had an intraday rejection of the 30 RSI under 30 over 30. It happened in a bullish order block. We also had a rejection of the negative third ATR channel. Got long here, 97.74. My emergency stop, 2 ATRs below. My end of bar stop, close below the 30 RSI. I placed my trailing stop level 1.5 ATRs above. And you can see the next day it gapped up big time. I hit a couple profit targets right off the bat, which was nice. Then we ended up actually closing down on the day, and I was really glad that I took some partial profits. Then here on the 9th, we had that huge day, third biggest day in the history of the stock market. I think I hit 5 profit targets on this move up. So I reduced my position size substantially, and then we also got to trailing stop level. Then the next day we gapped up a little bit. I took another profit target. Next day went up again. I took another profit target. Next day went up again, took another profit target. And then here on the 16th, we had our first close below a previous bar's low. And so I took off half. So currently, the half that I took off for a gain of 7.08%. And the remaining shares that I have currently up 3.55%. And one more rule here as well. If I take an under 30, over 30 trade like I did, and it gets to trailing stop level, which it did, then in the future, if I ever come back to break even, I'm completely out of the trade. So Monday, if we go down, I get to break even on the trade, I'll just exit the position and I'll be done with the position. Although still overall a nice positive trade because of taking the partial profits when I had them on the big up bars, taking half of the trade off here when we had a close below the previous bar's low. So anyway, I hope that makes sense, but I will be watching the video to see if it comes back down to my entry point next week. If it does, I'll just exit the trade, call it a good trade. But took off half on the 16th of April for a gain of 7.08%, and the remaining shares up 3.55%. Okay, let's go to the Qs. Excuse me. Excuse me, everybody. Okay. I did get long the Qs on the 8th of April. Why? Well, multiple reasons. Well, you see the green box here? That is a bullish order block. And that bullish order block goes all the way back to, goes back a ways. Why? What's going on with my charts here? Okay, this order block goes all the way back to April of 2024. Lowest bar close before we make a market structure change to the upside. I run that order block into the future, and look at that. That's about exactly where we got before we bounced. So there were a few things that went on here of why I took this particular trade. You've heard me talk about abandoned babies. You've heard me talk about island reversals. Well, we had an abandoned baby on the day that I took the trade. I took the trade on the 8th of April. Abandoned baby is when you have a gap down. You can see here on the 4th, we gap down. So overnight, the sentiment was very bearish, but then we gapped up. So we went from very bearish to very bullish in a very short amount of time. When this happens, about 70%, a little more than 70% of the time, if you have a gap down followed by an immediate gap up and you look into the future, we're going to be higher. So that was the first thing that caught my eye is we had a gap down, we had a gap up. And by the way, if you want to learn more about abandoned babies, island reversals, go to my YouTube channel. I have a video there you can watch and I explain in more detail what they are. In addition to that, on the day that I took the trade, we rejected the bottom of the bullish order block. You see how during the day we went below the order block and then closed back above the order block? So that gives me a good risk to reward ratio. So we had a gap down followed by a gap up, and we had a rejection of the bottom of the order block, which gives me a good risk to reward ratio. So I got long 416.26. I placed my emergency stop 2 ATRs below my entry. As always, my end of day stop is simply a close below the low of the order block, which is 412.79. So you can see that gives me a very good risk to reward ratio. I placed my trailing stop level 1.5 ATRs above my entry. And then the next day, it took off like a rocket ship. I think I hit 5 profit targets on this particular day. What does that mean? It means I took off 50% of the trade into that big monster up bar. pretty nice, right? And clearly we also got into trailing stop level. So the next day we gap up, I hit another profit target. The next day it goes up enough for another profit target. Here on the 14th, it gaps up again, another profit target. Remember, I am in trailing stop mode. And then here on the 16th, on Wednesday, was the first close below the previous bar's low after reaching trailing stop level. I took off half the position for a gain of 6.75%. And then on Friday, or Thursday, it was kind of a nothing burger, and the remaining shares I have on this particular trade up 6.31%, down a little bit. So anyway, this really worked out well. It's a good example of using a combination of the order blocks, deep dip buys, and a bullish abandoned babies. I know all these funny names, right? But anyway, pretty good. So very happy with that trade as well. So those are the two open trades now on the daily. NVIDIA remaining shares up 3.55%, and Q's remaining shares up 6.31%. So let's go to the closed trades. And remember, I didn't do the podcast because I was sick, but so let me show you the trade that I took on Verizon. I took this trade on Verizon on the 3rd of April. You can see I have a red box up here. If I have a red box, that means I'm looking to short. If I have a green box, it means I'm looking to buy. So this is called a bearish order block. And why is this a bearish order block? Well, here on the 10th of March was our highest up bar close, and then we change market structure to the downside. So if you change market structure to the downside, it's easy to identify your bearish order block. And if the market then in the future rallies back up and rejects the bottom of the order block or the top of the order block or has a V1 or a V2 in the middle, then that is a shortable area. And you can see on the 3rd, I got short at 44.92. Why? Because it rejected the bottom of the red box. So I got short 44.92. I placed my emergency stop 2 ATRs above. My end of bar stops a close above the high of the order block at 46.58. I placed my trailing stop level 1.5 ATRs below. And because I'm short, if it starts moving down, I take partial profits into that weakness. Well, I just nailed it, because the next day it just went down significantly. I hit multiple profit targets, reduced my position size, and we also got to trailing stop level. The next day down even more. So multiple profit targets. So with the deep dip buy or the deep dip short, I have certain rules that if I get to certain RSI levels, then I look to exit the trade if I have a close over the 5 EMA. And so again, I got short here, 44.92, went my way immediately, took profits. Next day went my way immediately, took profits. But and in this range down here, we got to a 35 RSI level. And if I ever get to a 35 RSI level on a short, more than likely I'm pretty close to the bottom. And so therefore, if I close over the 5 EMA, I'm simply going to get out of the trade. And that's exactly what happened here on the 10th of April, because I was in the low 30 RSIs here. And so if I'm in the low 30 RSI, 35 or lower, and I close above the 5 EMA, I get out of the trade. And that's what happened here on the 10th. We closed above the 5 EMA after getting into the low 30 RSIs. So I locked in, completely got out of the trade for a gain of 4.32%. But because of my partial profit taking, you can see the previous 3 days, I took multiple profit targets lower. So I am out of this trade on the short, gain of 4.32%. And then IBB. This was an excellent short trade. This, again, you see the red box. That means I am looking for a short. Well, here is your bearish order block on the 5th, highest up bar close. Here we change market structure to the downside. Here on the 21st, I got short at 138.90 because we rejected the bottom of the order block. So I position size correctly. I place my emergency stop 2 ATRs above. My end of bar stop is a close above the high of the order block, 160 to 142.62, and then I place my trailing stop level 1.5 ATRs below. I know this is difficult to see because there's been so much time and there's been such big moves, so I know it's a little hard to read this, but so I got short here again at 138.90. It moved down, it got to my trailing stop level, then I have my first close above a previous bar's high, so I get out of half the position, and so here this was a gain of 1.46%. Then we kind of started to move down sideways, but mainly down. I started taking more profits and more profits. Here on the 2nd of April, I went under 30, over 30. So I reduced my position again by half, and I locked in a gain of 9.65%. And then we just collapsed, so I continued to take more profits and more profits. As we got down into this level, we certainly got under the 30 RSI. And remember, if I get to 35 or lower and then close above the 5 EMA, then I'm going to get out of the entire trade. And that happened here on the 9th when we finally closed above the 5 EMA after being 35 RSI or lower. And so I exited the entire trade for, again, the remaining shares for a gain of 17.19%. So these order blocks are no joke. Whether they're bullish or they're bearish, really, they are no joke, and you should learn them. You know, I do teach private one-on-one lessons. I teach a 15-hour one-on-one course where I teach my students from all over the world. I teach them all the different trading approaches that I use, the deep dip buys, return to value, V1s, V2s, bullish order blocks, bearish order blocks, island reversals, abandoned babies. I love to teach. I have taught people from absolute beginners all the way up to hedge fund managers and everywhere in between. I have a lot of great students I'm teaching at the moment, and they're all doing great. But you know, if you would like to study with me, if you would like me to teach you everything I've learned in my 30-year career of trading, I'm very happy to do that. I'll do my very best for you, and I'll teach you everything that I know. So if you're interested, just send me an email. My email is the link of this YouTube video, and we can get the conversation started. But you will become a better trader. You will have really great processes and trading processes to follow. So send me an email and we'll get the conversation started. So I did exit the remaining shares on IBM on the short on the 9th of April for a gain of 17.19%. Okay, now let's go. So those are the daily trades, open and closed, and now let's go to the weekly trades. All right, so weekly trades close on Fridays, so I only have to make my decision on a Friday on a weekly trade. I got long TLT all the way back here on the 17th of January. Why? Well, you see the green box. That is a bullish order block on the weekly. On this particular week, I entered at $87.27 or 20 cents because we rejected the high of the order block. See, we went below it and then closed back above it. So that's a rejection of the high of the order block. So I got long here, 87.20. I position size, as we discussed. I placed my emergency stop 2 ATRs below. My end of bar stop on this particular trade was a close below the entry bar. Why? Well, the entry bar is what's considered a V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes under bar 1's low, closes above bar 1's close. You can see I put the line here, 86.20. That's halfway of the washout bar. It was a good spot for me to place a end of bar stop. So if we close below 86.20, I simply would be out of the trade, and it gives me a good risk to reward ratio. So after I entered, I placed my 1.5 ATR trailing stop level above, and as it moved up, I started to take some profits. The next week it went up but not enough for a profit target. Next week it went up. I did hit a profit target. The next week it went up. I hit multiple profit targets. Then we had a couple weeks of sideways motion. Nothing happened. Here on the 28th, had a big move up where I did hit multiple profit targets and also got to trailing stop level. Then we moved sideways for about a month. And then here on the 4th, another big up bar, which I took again, multiple profit targets. And then here on the 11th, we had the huge move down, kind of came out of nowhere. And I had to, it closed below a previous bar's low after reaching trailing stop level. So I gave up a lot of profit on that particular bar. But again, you see the advantage of taking the partial profits when I had them. So on this particular day here, or on the end of this week, I had to take a loss of 0.59% because it was the first close below a previous bar's low after reaching trailing stop level. Not a big loss, it's just that I gave up a lot of profit. But again, the move up where I took partial profits, you can see the benefit of doing that. It did not close below my end of bar stop, halfway of the washout bar. And currently, the remaining shares that I have up a little, just a little, up 0.33%. So the level that I'm watching here is this 86.20. If we close below it, I will just get out of the trade. If it keeps moving up, I'll continue to take partial profits. But all in all, this has been a nice profitable trade because of the partial profit taking. So the remaining shares up 0.33%. And then DDM is a short position on the weekly on the double leverage Dow. You can see here was your bearish order block as indicated by the red bar, the red box. Highest up bar close before you change market structure to the downside. When you change market structure to the downside, I am looking to short any rallies with rejection of that order block. That happened here on the 31st of January. I got short at 103.70 with the rejection of the bottom of the order block. I placed my emergency stop 2 ATRs above. My end of bar stop is a close above the high of the order block at 107.53. I placed my trailing stop level 1.5 ATRs below, and then it just went down. Next week, I took some partial profits. Next week, nothing. Next week, more partial profits. Next week, nothing. Next week, down significantly. I hit multiple profit targets, also at trailing stop level. Next week, down more. Then we had a couple weeks of sideways motion. And then here on the 4th, had this significant move down where I hit multiple profit targets. 2 weeks ago, we went under 30, over 30. So that was my signal to exit half of the position. I locked in a gain of 25.62% on that particular week. And at this point, I am just waiting for a close above the 5 EMA to get me out of the trade, or a close above a previous bar's high. So again, I locked in 25.62% 2 weeks ago, and then the remaining shares that I have on this particular short up 32.55%. So really good example of looking for a market to change structure to the downside and then shorting that first initial rally. Another way to look at it, this is kind of counter punching. I would not have shorted this unless we change market structure to the downside. But once we change market structure to the downside, I'm looking for counter rally shorts, and you can see that worked out really well. So gain of 32.55% on the remaining shares. And then last but not least is Nike. I did take a position in Nike on Thursday at $55.80. And so let's look and see why I took that trade. This is just a deep dip buy. Look, the RSI level is 30.71. During the week, we were lower than 30. So this was an intra-week rejection of the 30 RSI. During the week, it went below. At the end of the week, it closed above. I got long 55.80. I placed my emergency stop 2 ATRs below. My end of bar stop is simply going to be next Friday. If we close below the 30 RSI, I am out of the trade, and I place my 1.5 ATR trailing stop level 1.5 ATRs above. So I know exactly what I'm going to do in this trade regardless of what happens. If it goes down next week, gets to my emergency stop, what do? I get out, I take a 1% loss. That only happens 5% of the time. If it closes next week below the 30 RSI, I'm simply out of the trade there for my end of week stop. If it moves up, right now, look, the 0.45 value is 2.46. So I take 55.76, add 2.46. That's my first profit target for the week. Then I do that 2 more times, so I have 3 profit targets. So if it moves up, I take partial profits. If it moves up enough to get to my trailing stop level 63.90, then I'm in trailing stop mode. So do you see, regardless of what happens here, I know exactly what I'm going to do. And as a trader, that's what you need to have. You need to have rules that tell you exactly what to do, because you cannot control the market. I can't control the market. All we can do is control what we are going to do if the market changes. And it will change. Guaranteed, this is either going to go up or go down. Almost certainly I can guarantee you that. But I need to know what I'm going to do regardless of what it does. And so that's why it's important that you learn a process, more importantly, that you follow that process. So basically just exactly break even on that trade. So those are all the trades and kind of a catch up from 2 weeks ago. So I did get rid of Verizon. I did get rid of IBB. So we're done with those. I've been in trade for a long, long time, but hopefully those were good examples. So, all right, let's talk a little bit about trader psychology before we take a look at potential trades for next week. All right, everybody. This is from Money Trade Edge, Better Thinking, Better Trading. You can follow him at Money Trades on X, on Twitter, or on X. And let's have a look and see what he says today. I really like this. From zero to trading success. Number 1, practice study like no one else. Number 2, find a trading edge. Number 3, focus 100% on your trading edge. And number 4, execute it for the next 5 years. Now, this is music to my ears, everyone, because this is what I preach every day, every weekend on the podcast. Get yourself a trading process and then focus on it. Regardless of what the market does, get yourself a rule-based trading process. When you're done in 5 years, if you have a good process and you follow it, you're going to do fine. I promise you're going to do fine. Where people get into problems is where they get away from their trading process. So number 1, practice study like no one else. Listen, I've been trading for 30 years, and when I first started trading, I had a really tough time of it. I was very young, I had a lot of money, and I was just in there gunslinging. And when I first started, I lost a lot of money, and what I did is I went out to many famous traders, many famous authors, and I begged and pleaded with them, please teach me how you trade. And they did. I paid a lot of money for it, but I learned how they trade, and they taught me. And this is what I use today. It's a compilation of all the different trading approaches that I've used from these traders and authors, and it works, right? And this is what I teach, but you have to learn it one way or another, whether someone teaches you or you have to, find it out for yourself. It doesn't matter. But first of all, you need to practice and study like no one else. Number 2, find a trading edge. Well, if you're using a good trading process with proper position sizing, multiple confluences of signals, good risk to reward ratios, there you go. You will have yourself an edge. Number 3, focus on that trading edge, or in other words, follow that process regardless of what the market does. And number 4, execute it for the next 5 years. If you want to be a profitable trader, here's your roadmap right here. Practice study like no one else, find yourself a trading edge, focus on that trading edge, and execute it perfectly for the next 5 years. So it's good advice. Like I said, if I can help you, more than happy to do that. If you learn it from someone else, that's great too. But do yourself a favor, be good to yourself, and find yourself a process that you can just execute day in, day out, month in, month out, year in, year out. And you'll find success in trading. Okay, let's talk about the potential trades for next week. And I always mention this before um, before I get into this, but you can see here on the daily, I have 6 potential symbols that I'm looking at for next week that are getting close to potential buy areas and so forth. Now, Monday morning, could all 6 of these trigger at the same time? Yes, they could. Doesn't mean that I'm going to take all 6 positions. No. I have a rule where I only take 1 position per day. Even if I have 6 or 7 or 10 different setups, I'm still going to take one. I'm going to take the best one. How do I decide what's the best one? Well, I give them a score. If one market has 1 entry signal, but a second one has 2 entry signals, which one do you think I'm going to go for? I'm going to go with the one that has the highest quality score, which involves how many signals, how many setups, what does it look like on multiple time frames, what's the risk to reward ratio, what's the relative strength of that market compared to the rest of the market. This is really how you excel in trading, is narrowing down multiple signals and picking the best one, right? So that's what I do. I give every single one a report card, and I pick the one that has the highest score. And this is what I teach my students. The devil is in the detail in trading, and that's why I teach my students this exactly, how to narrow down the best trade if you have multiple trades. And so if you become my student, one-on-one student, I will teach you this as well. So let's start with Alibaba. Okay, so Alibaba, this would be a deep dip buy, potential deep dip buy. You can see the major moving averages, the deep dip buy moving averages, the 200, the 250, the 300 below. We are not there yet, but next week, if we do come down and we reject the 200-day moving average, or reject the 250, or reject the 300-day moving average, then I would consider getting in the trade, because the market's shown me that there are no more. If it rejects the 200, it means there's no more sellers under the 200, or if it goes further to the 250, that there's no more sellers under the 250. Doesn't mean in the future it can't go down further, but it's a good piece of information. It's a good piece of intelligence to help you make that decision. In addition, we're at a 39.57 RSI. If we go lower into the 200, the 250, or the 300, very likely we will get to a 30 RSI. And some of the best setups that you could potentially ever take are a combination of a rejection of a major moving average at the same time you have a rejection of the 30 RSI. And this is full on deep dip buy approach here, but I love deep dip buys. I've been using them for decades. I teach them, right? I also have a video course available, by the way, at udemy.com. It's 9.5 hours, and I teach you step by step just the deep dip buy setup, and the links in this YouTube video if you'd like to take a look at that course. It's very affordable, but it has a lot of content, 9.5 hours of video. And so if you take that video course, you will know the deep dip buy when you are done, I promise you. So that is what I'm looking for on Alibaba. Is it's not where it needs to be yet, but it is getting close. And that's the importance of having patience, of identifying, okay, we are getting close to these levels. We're not there yet. I'm not going to take action unless we have some kind of rejection of the moving averages. So the first one I'm looking at is the 200, second one 250, third one is the 300-day moving average. And again, if we get into these levels, we'll be in a low 30 RSI level, which will help sweeten the deal and help improve the chances. But we'll see, right? I can't anticipate it. I need the market to show me that it's going to reject one of those levels first. Johnson & Johnson, J&J. Okay, well, you see the red box up there. What does that mean? Well, it means this is a bearish order block. Here is your highest up bar close. Here, the next day, we broke market structure to the downside. So if you break market structure to the downside, I'm looking to short if we rally back up to that bearish order block. We're not there yet, so I'm not taking the trade yet. It may just go down from here and I miss the trade. But what I'm really looking for next week is a rejection of the bottom of this order block. The bottom of this order block is at 164.23. The high of the order block is 166.63. So a rejection of the bottom of the order block or a rejection of the high of the order block is what would get me interested in getting short, but it's not there yet. Coca-Cola, same thing. Look, here is your bearish order block. Highest up bar close before we change market structure to the downside. Doesn't mean I want to short there. It just means I want to short a rally back in the order block. Well, we are back in the order block, but we did not reject the bottom of it. See how we closed inside? So going forward, if we go higher and reject the high of the order block, I could get short there. Ideally, that would be the perfect trade because it would give me the best risk to reward ratio. Or if we go down and close under the order block, I could also get short there as well. So ideally, what I'd like to see it is move up, reject the high of that order block, giving me a very good risk to reward ratio to get short. And the other thing, what's telling me, we just looked at Johnson & Johnson, we looked at Coca-Cola. These are defensive stocks. These are defensive consumer stocks. And so in times of volatility and the market going down, these tend to usually catch a bid and go up because money is fleeing into these safety stocks. Well, if stocks like Johnson & Johnson and Coca-Cola are in a bearish order block now and are starting to reject bearish order blocks, what that tells me is that the regular market, the growth market, will probably have a rally and these will probably go down. So seeing these defensive stocks in these bearish order blocks, to me, is giving me a little bit more confidence that the market in general, the growth side of the market, probably has more upside potential from here. Meta, META. Okay, well, we're getting pretty close to a bullish order block. It's interesting. Look at this bullish order block here on the 7th. Look at this. What was the bottom? Exactly at that order block. And then we rallied substantially. Now we're coming back down. So what am I looking for in the future? I'm looking for a rejection of the high of this order block here at 483.63. So Monday, if we come down to that order block and then close above, that would be my entry. I would position size. I place my emergency stop 2 ATRs below, and my end of bar stop would simply be a close below the low of the order block at 448.84. Microsoft. Okay, here's bullish order block. You can see we went below the order block. We closed above the order block. I didn't take this trade because the risk to reward is not good. It was too far extended. But now we're back in the order block. Just because we're in the order block doesn't mean I take the trade. I want to see a rejection of the bottom of this order block at about 362.81 or a rejection of the high of the order block here at about 372.26 or some type of V1 or V2 inside the order block. So there's three options that I'm looking for. Rejection of the bottom of the order block, 362.22, rejection of the high of the order block, 372.46, or some kind of V1 or V2 in the order block. That would also get me potentially long. But we are back in the order block. I just need a rejection of the bottom or the top or a V1 or a V2 in the order block to potentially get long here. Last but not least is UNG. Well, I was teaching a student of mine on Thursday, and we were going through charts, and we were looking for potential setups. And when we were looking at UNG, I said, I will definitely talk about this on the podcast this weekend because this is a deep dip buy setup. We're not there yet, but look, we are. Here's the 250-day moving average. Here's the 300-day moving average. Here's the 200-day moving average. All major moving averages. Let's look at the RSI. The RSI is 3468. So if we come down lower and reject one of these major moving averages, very likely our RSI will potentially be at 30 RSI. And remember what I just told you a little while ago. The combination of a rejection of a major moving average at the same time that you have a rejection of the 30 RSI is one of the best setups that you can have. It doesn't mean it's going to be a profitable setup, but it's a good risk to reward ratio with a high probability of being profitable. And so I'm just waiting for UNG to reject one of these major moving averages, and then I would consider taking the trade. So those are the daily trades, and let's finish off with the weekly trades. Okay. Well, you see a red box. What does that mean? That means I'm looking for a short. You have your bearish order block here. 328 is your highest up bar close. You change market structure to the downside. I'm looking for a continued rally back up and the rejection of the bottom of the order block. The rejection of the bottom of the order block's 42.58. The rejection of the high of the order block's 47.85. So somewhere inside here, I would be looking for a short. First step, looking for a rejection of the bottom of the order block. Second step, looking for a rejection of the higher order block. The third would be some kind of V1 or V2 to the downside inside the order block. So there is no trade here yet, but if we rally higher and reject something in the order block, I would look for a short on AGQ, which is double leverage silver. MS, which is Morgan Stanley. Okay, you see the green order block. I'm looking for some type of buy. You can see this is over the last couple of weeks, we got to the order block, and that's exactly where it bounced. I could have taken this trade last week, but it was too far extended above the order block, so it doesn't give me a good risk to reward ratio. So I'm looking for a pullback to the high of the order block at 101.88 or a rejection of the low of the order block at 94.32 or somewhere in between. But it has to go lower for me to get interested. And again, the first stop would be a rejection of the high of the order block at about 101.74 or a rejection of the low of the order block at 94.89 or a V1 or V2 inside the bullish order block. Microsoft on the weekly. Well, here's your green order block area. 2 weeks ago, we closed below the order block. That's not a legitimate trade. The week after, it rejected the high and the low of the order block, but it's too far extended. So now we are right in the order block in a reasonable area. So if it goes lower and rejects the bottom of the order block, 362.95, which is about 5 points below, so it would have to go below, reject the bottom of the order block, close back in above, I potentially get long there. Or if we close above the high of the order block next week at 372.54. So looking for a long there. SPY, okay. Well, we are in an order block on the SPY as well. And kind of an interesting spot here on the SPY. So my first thought is that I would like it to see it go down, reject the bottom of the order block at about 508.92, or close above the high of the order block here at 535.27. So, could I buy it right here, right now? Yeah, I could. I want to get a better risk to reward ratio, and I want to get a better entry with more confirmation that we're rejected the bottom or the top of the order block. You see, I drew this green line here, 519.50, and let me show you what that is. It's relevant on the daily. Well, on the 9th, we had the big up bar move. And whenever you have a huge big up bar, a good place for support is if you come down to halfway of this bar. Here's the bottom, here's the top. Halfway is right here. Look at that. As we move down, you see how we got right 2 days ago, or on Wednesday, we got basically right to that halfway, and that's exactly where we bounced. So I was kind of expecting a pullback after this big move up to about the halfway, and that's exactly where we are. So this is on the daily. We're inside the order block of the weekly, and we rejected the halfway of that bar there. If we go back to the weekly, that again, we rejected the halfway of the big up bar on the daily. But again, just to be clear, looking for a rejection of the bottom of the order block at about 509.31 or the high of the order block at about 434.88. Walmart on the weekly, okay, well, you have a red box. This is your bearish order block. Highest up bar close. We change market structure to the downside. Now looking for that counter rally to reject the bottom of the order block. The bottom of the order block here is at $100.97. The high of the order block is at 105.01. So we're not there yet. I won't short unless we reject the bottom of the order block or the top of the order block, or we have some kind of V1 or V2 reversal inside the order block. That would potentially get me short. And then last but not least, everyone, is XLV, which is healthcare on the weekly. Look, we're below the 200-week moving average at the moment. Next week, if we close above the 200-week, I could potentially get long there with the 200 weekly as my end-of-week stop. Or if we go lower, a rejection of the 250-week moving average would also be a potential. And what I like about this is that you can see the red bars here. We have what's called a double bottom and a bullish MACD divergence. Look at this low here. Look how deep the red MACD bars are. This is an indication of momentum. A lot of momentum to the downside, as illustrated by the depth of these red bars. Then we rally. But here we are lower now than we were over here, but yet the MACD bars are not as deep here as they are over here. This is showing from a MACD perspective that we are potentially running out of sellers. The momentum, the selling momentum is being reduced. And if the selling momentum is being reduced, the implication is you are going to go higher. So big picture, I like the double bottom with the bullish divergence. This looks bullish to me, but I still need to get a close above that 200-week moving average as a potential entry point here, or if we go lower, a rejection of the 250-week moving average down here. So those are the markets that I'm looking at next week. If you have any questions about any of these, please put them in the comment section. I'll do my best to get back to you as soon as I can. I hope you have a good rest of your week. If I can help you with anything, please let me know. Love to have you as a student, teach you everything I know. You're going to come out of this with a great skill and something you'll be able to use for the rest of your life. So my email's in the link in the description. Send me an email. We get the conversation started. If you're interested in the online course at udemy.com, the link is in the description of this YouTube video as well. I hope you have a good rest of your weekend. Please be safe next week. And, I always like to leave off with, please try to do something nice for somebody today. If we could all do one nice thing for another human being every day, it would just make the world a better place. And if you could also go out, do something nice for an animal, that would be great. They appreciate acts of kindness just like we do. So I apologize for my voice. I apologize for not doing the podcast last week, but thanks again for your support, everyone. If you found something helpful, I appreciate if you hit the thumbs up button or even subscribe to the channel. That would be great as well. But enjoy your rest of the weekend, and God willing, I will see you next week. So thanks again, everyone. Take care. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.